Unlocking the stock market, your path to financial growth. The journey to financial growth can be both exciting and daunting, but with the right knowledge and tools, you can navigate it successfully. The stock market can seem intimidating at first. The sheer volume of information, the fluctuating numbers, and the complex jargon can overwhelm anyone new to investing. But don't worry, it's easier than you think to get started. With the right guidance and resources, you can begin your investment journey with confidence. Investing in the stock market is one of the most powerful ways to grow your wealth over time. By consistently investing, you can take advantage of compound growth, where your earnings generate even more earnings. When you buy stocks, you're buying a small piece of ownership in a company. This means you have a stake in the company's future success. As the company grows and becomes more profitable, the value of your shares can increase. This growth can lead to significant returns on your investment over the long term. This means you can potentially earn money through your investments, whether it's through capital gains, which is the increase in the stock's price, or dividends, which are a portion of the company's profits paid to shareholders. The stock market is like a bustling marketplace where buyers and sellers come together to trade shares of publicly listed companies. It's a dynamic environment that operates on the principles of supply and demand. It's a dynamic environment where prices fluctuate based on supply and demand. These fluctuations can be influenced by a variety of factors, including economic indicators, company performance, and global events. By understanding the basics of how the stock market works, you can make informed investment decisions and potentially achieve your financial goals. Knowledge is power, and the more you learn about the market, the better equipped you'll be to navigate its ups and downs. Remember, investing in the stock market involves risks, but it also offers significant potential rewards for those willing to learn and participate wisely. Diversifying your investments, staying informed, and being patient are key strategies to help you succeed in the stock market. So, take the first step, educate yourself, and embark on your path to financial growth today. Understanding the basics: stocks, shares, and exchanges. Let's start with the basics. What are stocks and shares? A stock represents a unit of ownership in a company. When you buy a share of stock, you're essentially becoming a part owner of that company. The more shares you own, the larger your ownership stake. The stock market is where these shares are bought and sold. It acts as a platform connecting buyers and sellers, facilitating the exchange of ownership in companies. Think of it like a giant auction house, but instead of art or antiques, you're trading shares of companies. These exchanges provide a regulated and transparent environment for investors to trade with confidence. Some of the most well-known stock exchanges include the New York Stock Exchange, NASDAQ, and the London Stock Exchange. How the stock market works: a beginner's guide. Now, let's delve into how the stock market actually works. The stock market is a complex system where shares of publicly traded companies are bought and sold. It serves as a platform for companies to raise capital by issuing shares to investors, who in turn can buy and sell these shares among themselves. When a company performs well, its stock price tends to go up. This can be due to strong earnings reports, successful product launches, or positive market sentiment. Investors are willing to pay more for shares of a company that is perceived to have a bright future. Conversely, if a company faces challenges, its stock price may decline. This could be due to poor financial performance, negative news, or broader economic downturns. Investors may lose confidence and sell their shares, driving the price down. This fluctuation in stock prices is influenced by various factors, including company performance, industry trends, economic conditions, and investor sentiment. For instance, changes in interest rates, inflation, and geopolitical events can all impact stock prices. Analysts and investors constantly monitor these factors to make informed decisions. To buy or sell stocks, you'll need to open an account with a brokerage firm. This can be done online or in person. Brokerage firms provide the platform and tools necessary for trading stocks, and they charge fees or commissions for their services. Brokerage firms act as intermediaries, executing your trades and providing you with access to the stock market. They offer various types of accounts, including individual and joint accounts, as well as retirement accounts like IRAs. Once you've opened an account and deposited funds, you can start placing orders to buy or sell stocks. It's important to research and understand the stocks you're interested in before making any trades. Many brokerage platforms offer educational resources and tools to help you make informed decisions. You can choose to place market orders, which are executed at the current market price, or limit orders, which allow you to set a specific price at which you're willing to buy or sell. Market orders are typically executed quickly, while limit orders may take longer to fill, depending on the market conditions. Staying informed about market news and trends is crucial for successful investing. Regularly reading financial news, following market analysts, and keeping an eye on economic indicators can help you make better investment decisions. Technology has made it easier than ever to stay connected to the stock market. With mobile apps and online platforms, you can monitor your investments, place trades, and access real-time market data from anywhere. Consider seeking advice from financial advisors or joining investment groups to gain insights and share knowledge. Experienced investors can provide valuable perspectives and help you navigate the complexities of the stock market. Finally, it's important to have a clear investment strategy and set financial goals. Whether you're investing for short-term gains or long-term growth, having a plan can help you stay focused and make disciplined decisions. With the right knowledge and approach, anyone can participate in the stock market and work towards achieving their financial goals. Remember, investing is a journey, and continuous learning is key to success. Section 4. Taking the first step. Practical tips for new investors. Taking the first step into the stock market can feel overwhelming, but it doesn't have to be. Start by educating yourself about investing basics. There are countless resources available online at your local library, and even through workshops and seminars. Next, determine your investment goals. Are you saving for retirement? A down payment on a house? Having clear goals will help you stay focused and make informed investment decisions. Once you have a good understanding of your goals, you can start developing an investment plan. Consider factors such as your risk tolerance, time horizon, and financial situation. Remember, investing in the stock market involves risks, so it's essential to invest only what you can afford to lose and seek professional advice if needed. Section 5. Choosing your investments. Research and due diligence. With countless companies to choose from, selecting the right investments is crucial. Start by researching companies that align with your interests or industries you understand. Look into their financial performance, management team, and competitive landscape. Consider their track record of profitability, revenue growth, and debt levels. A company with a strong financial foundation is more likely to weather economic downturns and deliver long-term value to investors. Don't be afraid to diversify your portfolio by investing in companies across different sectors. Section 6. Strategies for success, diversification, and long-term growth. In this section, we will delve into the importance of diversification and how it can contribute to long-term growth in your investment portfolio. Diversification is key to mitigating risk in the stock market. By spreading your investments across various sectors and asset classes, you can protect yourself from significant losses. Imagine putting all your eggs in one basket. If that basket falls, you lose everything. This metaphor perfectly illustrates the risk of not diversifying your investments. The same principle applies to investing. By diversifying, you ensure that the poor performance of one investment doesn't drastically affect your entire portfolio. By spreading your investments across different companies, industries, and asset classes, you reduce the impact of any single investment on your overall portfolio. This strategy helps in balancing the risk and reward. Another important strategy for beginners is to focus on long-term growth. Long-term investments allow you to take advantage of the market's overall upward trend. The stock market can be volatile in the short term, but over the long run, it has historically trended upwards. This means that despite short-term fluctuations, the market generally grows over time. Instead of trying to time the market or make quick profits, aim to invest in quality companies with strong growth potential and hold on to those investments for the long haul. This approach minimizes the stress of daily market monitoring. This approach allows you to ride out market fluctuations and benefit from the power of compounding. Compounding is the process where the value of an investment increases because the earnings on an investment, both capital gains and interest, earn interest as time passes. Remember, patience is a virtue in investing. Staying calm and patient during market downturns can prevent you from making impulsive decisions that could harm your long-term financial goals. Diversification and long-term growth strategies are not just for seasoned investors. Beginners can also benefit greatly from these approaches. By starting early and staying committed to these principles, you can build a robust portfolio that stands the test of time. One practical way to implement these strategies is by setting up automatic investments. Regular contributions to your investment portfolio can help you take advantage of dollar-cost averaging, which reduces the impact of market volatility. A well-diversified portfolio typically includes a mix of stocks, bonds, and other asset classes. This mix can be adjusted based on your risk tolerance, investment goals, and time horizon. By adhering to these strategies, you can achieve significant milestones in your investment journey. Diversification and long-term growth are foundational principles that can lead to financial success and security. In conclusion, diversification helps mitigate risk, and focusing on long-term growth allows you to benefit from the market's overall upward trend. Together, these strategies can help you build a resilient and prosperous investment portfolio. Stay diversified, stay patient, and stay committed to your long-term goals. Your future self will thank you for the wise decisions you make today.